U.S. estate tax as a Canadian. What you need to know. U.S. situs assets. Do you know that simply owning U.S. stocks or a vacation property in Florida might make you liable for U.S. estate tax, even if you're not a U.S. citizen or resident? Let's dive into what this means and how you can protect your legacy and your loved ones. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. U.S. estate tax and Canadian investors. Many Canadians invest across the border, buying real estate or holding U.S. stocks like Apple or Microsoft. What most people don't realize is that those U.S. assets are known as U.S. situs assets, and they could expose your estate to U.S. estate taxes when you pass away. What are U.S. situs assets? A U.S. situs asset is any asset that's considered to be located in the U.S. for tax purposes. This includes U.S. real estate, shares of a U.S. corporation, yes, even if held in a Canadian brokerage account, tangible property located in the U.S., certain interests in U.S. partnerships, LLCs, or trusts. Even if you're 100% Canadian, the IRS still considers these fair game for U.S. estate taxes. How does U.S. estate tax work? So how much could this cost your estate? As of now, the U.S. estate tax kicks in at 40% for estates exceeding the exemption threshold. For Americans, that exemption is over $13 million in 2024. But for non-resident aliens, like Canadians, that exemption is just $60,000. It's a huge difference. If you own U.S. situs assets worth more than $60,000 at death, your estate may have to file a U.S. estate tax return and potentially pay U.S. taxes on those assets. Are there any credits or treaties that help? Thankfully, Canada and the U.S. have a tax treaty that offers relief. Two big tools help here. Number one, the unified credit. A portion of the U.S. exemption is available to Canadian estates based on the ratio of U.S. assets to the worldwide assets. Two, marital credit. Allows a deferral if assets go to the surviving spouse, provided certain conditions are met. But remember, these credits don't eliminate the tax, they just reduce it or defer it. Strategies to reduce or eliminate U.S. estate tax. Let's go deeper into the strategies Canadians can use to reduce or eliminate U.S. estate tax exposure. The right structure can make a huge difference. So here are several key options you should know. Use Canadian mutual funds or ETFs. First, instead of buying U.S. stocks directly like Apple, Google, or Tesla, consider buying Canadian mutual funds or ETFs that hold those stocks. Why? Because you then own shares of a Canadian corporation, not a U.S. one, and that removes them from the U.S. estate tax net. Hold U.S. real estate through a Canadian corporation. If you own a vacation home or rental property in the U.S., consider owning it through a Canadian corporation. This can keep the assets out of your estate for U.S. tax exposure. However, be careful. Corporate ownership can trigger other issues, such as double taxation. Use a trust or cross-border trust planning. A properly structured trust, especially one set up before you acquire U.S. assets, can be an effective estate planning tool. It can remove the assets from your personal estate, potentially shielding it from U.S. estate tax. Cross-border trust planning is complex, so this one requires expert legal and tax advice. Own U.S. assets through a Canadian holding company. Similar to trusts, using a Canadian holding company can help you keep U.S. assets out of your personal estate. It also gives you more control over succession and income flow. But again, there are pros and cons. You have to consider Canadian tax on foreign income, potential double taxation, and administrative costs. Gift or sell U.S. assets during your lifetime. Another strategy is to gift or sell your U.S. situs assets during your lifetime. By reducing the value of your U.S. assets, you lower or eliminate your estate exposure. Keep in mind, this could trigger capital gains tax in Canada, so it's essential to plan carefully. Life insurance to cover U.S. estate tax. Finally, if you can't or don't want to restructure your assets, a life insurance policy can be a clean solution. The policy pays out a tax-free benefit to your beneficiaries and can be used to cover any U.S. estate tax liability that arise. Work with a tax planning specialist. As you can see, U.S. estate tax is a complex issue for Canadians with cross-border investments. What works for one person might not work for another. The rules change and the IRS doesn't mess around. That's why it's critical to speak to a qualified tax planning specialist, especially one with cross-border experience. They'll help you tailor a plan that fits your financial goals, protect your estate, and avoid nasty surprises for your family down the road. If you found this video helpful, make sure to like and subscribe, drop a question in the comments, and I'll do my best to cover them in future videos. Until next time, plan smart and protect your wealth.